Hey everyone, welcome to This Explainer. Today, we're going to demystify the complex arithmetic behind long-term financial planning and, more importantly, uncover the hidden costs of aggressive business expansion. We hear all the time about companies striving for massive, double-digit growth, but we rarely look under the hood to see what that growth actually costs them. Now, you might be wondering about the paradox here. We naturally assume higher sales equal financial health, right? I mean, if you're selling more, you must be making more money. But as we're going to see through the numbers today, rapid growth often drains a company's cash reserves way faster than it fills them. Okay, let's take a quick look at our roadmap for today. We'll start with the blueprint for growth, look at the anatomy of a model, dive into a case study on dynamic mattress, cover pitfalls and capacity limits, discuss valuing the future, and wrap up with the speed limit of growth. Let's get right into it. Section 1. The blueprint for growth, mapping the financial horizon. So pretty much every business plans, but the time horizons dictate completely different strategies. While short-term planning is really just about keeping the lights on for the next 12 months, making sure bills are paid, managing short-term borrowing, long-term planning is a whole different beast. We're talking about plotting out multi-year investments, over 5 years. This is where a company decides to do things like build new generating plants or invest in future tech that might not pay off today, but secures their survival a decade down the line. Why do we build these elaborate plans instead of just forecasting? Well, forecasting really just concentrates on the single most likely outcome. But planners don't just forecast, they build these models to manage risk through what-if contingency scenarios. Like, what if interest rates absolutely skyrocket? What if inflation surges? Plus, planning forces consistency. It ensures that a CEO's incredibly ambitious targets, like wanting a 10% profit margin alongside a 20% sales growth, are actually mathematically possible. Sometimes, to get that kind of growth, you have to slash prices, which totally kills the profit margin. A good plan catches that contradiction early. Section 2, Anatomy of a Model, the Financial Engine. Think of a financial model exactly like a mechanical engine. It's a simple, elegant, three-step flow. You feed current financial statements and market forecasts in as the raw fuel. The equations inside the planning model process them. That's your engine block mapping out key relationships. And out comes your projected performance. It automates all the heavy arithmetic so managers can quickly trial and error different strategies. And the dashboard of this engine gives you what finance folks call pro formas, which really are just projected balance sheets and income statements. But it also spits out cash flow forecasts and critical financial ratios. These outputs are the vital signs of your future business. They tell you instantly if your big strategic plan leaves you dangerously leveraged or wonderfully profitable. Section 3. Case Study. Dynamic Mattress, Fueling the Growth Engine. Let's see this in action. Our hypothetical company, Dynamic Mattress, uses a percentage of sales model. This is incredibly common in the business world. It just means we assume that as their sales go up, things like their cost of goods sold and the inventory sitting in their warehouses are going to increase proportionally. Sales drive the entire vehicle here. So if we want to find out how a massive 20% jump in forecasted sales hits Dynamic Mattress, we literally just follow the cash in 3 steps. First, we project the operating cash flow. Second, we calculate how much cash is going to be eaten up by new working capital, new fixed assets, and the dividends they promise to pay out. And third, we put it all together into a future balance sheet. Easy enough, right? Well, when we actually run the numbers for their 2022 forecast, a pretty startling picture emerges. A 20% growth rate pushes their revenue to $2.64 billion. That's a huge number. But look at the costs. Cost of goods sold eats up 92% of that. After taxes, they have a modest net income, but they're committed to paying out 60% of it to shareholders as dividends. So despite billions in top-line revenue, their heavy payouts and high costs leave them with only $35.5 million to actually reinvest back into the business. And here is where the math really bites back. Because their sales are growing by 20%, they desperately need more fixed assets, like new machinery and more working capital to actually fulfill those orders. We use this exact formula to figure out the cash shortfall they're going to face. We add up the required investments in working capital and fixed assets, add the dividends, and subtract the cash flow they actually generate from operations. Check out the stark reality of this growth paradox. Their total uses of cash hit $181.4 million, but their operating cash flow, only $113.5 million. To achieve that 20% growth, Dynamic Mattress is forced to borrow an extra $67.9 million. This required external capital pushes their debt ratio from 17% all the way up to 25% in just 1 year. Growth isn't generating free cash here, it's actively consuming it. Section 4. Pitfalls and capacity limits when spreadsheets meet reality. Before we get too carried away, we gotta acknowledge a major pitfall in how these spreadsheets work. Let's look at another company, Carter Tools. If they're operating at 100% capacity, a 50% jump in sales requires a massive $10 million investment in a totally new factory. But if they're only operating at 75% capacity, they have slack in this system. That exact same sales surge only requires $6.25 million in new assets. This proves that simple percentage-based spreadsheets can easily overestimate your capital needs because they assume everything scales perfectly. You've got to remember, models do not make decisions. They are just tools that blindly follow the rules you give them. The percentage of sales foundation is a great starting point, but it's flawed. It assumes fixed costs scale smoothly, which actually, scratch that. It assumes they scale perfectly proportionally, which just isn't true. You can't exactly buy half a factory, right? Planners also have to manually adjust for complex depreciation and taxes, ensuring they don't just generate useless accounting numbers, but real tangible cash flows. Human judgment is absolutely crucial to bridge the gap between a spreadsheet and reality. Section 5. Valuing the future, making the strategic justification. So if growth costs so much money up front, how on earth do we justify it? The answer lies in long-term value creation. By forecasting free cash flows out 5 years to 2026, accounting for the firm's long-term horizon value, and applying a 15% cost of capital, planners can run a present value calculation. And the result for Dynamic? The firm's present value sits at a very healthy $912.8 million. This strategic justification proves that even though they have to borrow heavily today, the overall strategy generates excess returns in the future that make the whole shebang totally worth it. Section 6. The speed limit of growth, finding the internal growth rate. This brings us to the grand finale of our explainer, calculating the exact mathematical threshold where a company simply runs out of its own cash. Look at how the required external financing absolutely explodes here. At a modest growth rate of 5.9%, they don't need a dime of outside money. But push that growth to 10%, they need almost $20 million. Push it to 30%, suddenly they're in the hole for over $116 million. It's a direct correlation. Higher growth rates strictly demand more external capital. That magical $0 mark is what we call the internal growth rate. It's literally the maximum rate a firm can grow relying entirely on its own reinvested profits. For Dynamic Mattress, we calculate this by multiplying 3 simple factors: their plowback ratio, which is just how much profit they actually keep, their return on equity, and their equity to asset ratio. Run those numbers, and the math spits out exactly 5.9%. You can see it visually right here where the line crosses the zero axis. If Dynamic Mattress tries to push its sales growth any faster than 5.9%, it mathematically cannot fund itself. It crosses that line into positive required external funds, meaning it has to go beg the banks or issue new stock just to stay afloat. It's a hard speed limit. So here's the million-dollar question to wrap up this explainer. If your company's internal speed limit is 5.9%, is that aggressive 20% expansion plan building an empire, or just digging a massive debt trap? The absolute most crucial takeaway here is this: growth is never free. The faster you accelerate, the more fuel you burn. And without a fully integrated, long-term financial plan to anticipate that cash burn, you might not be building an empire at all. You might just be accelerating your company straight off a financial cliff. Thanks for joining me on this deep dive into the numbers that truly drive business. See you next time.